Hey, welcome to the podcast, everybody. Thank you for joining me here on this gray, gloomy afternoon. Of course, we're here in South Texas where we do the podcast from, and had some thunderstorms roll in this afternoon. Of course, this whole week, this weekend, they're playing the Valero Texas Open here in San Antonio. So hopefully those folks won't get rained out, as it's always a nice draw for the city. Well, it was also gloomy on Wall Street today. The Dow Jones dropping 112 points, down about 130, 140 at one point. The NASDAQ dropping 36 points. The S&P dropping almost 17. So the S&P, the Dow Jones held up the best as it's been doing. You saw what happened yesterday where the small caps were down. Small caps down again today, the worst, 1.67% down today, whereas the Dow was only down 0.76. So you're seeing about more than double the downdraft on the Russell 2000 when compared to large cap stocks. So certainly it's kind of a classic. What's going on right now is kind of a classic, risk off scenario. And I did a blog article yesterday where I outlined that there were some short-term concerns. And again, I want to be clear for those that are new to the podcast, and I talk about this all the time, it's very important that we discuss time frames, because when I say I'm getting concerned or where I'm saying I like the way the market looks, you don't necessarily know what time frame I'm talking about, and I usually try to explain it. But when I talk about short-term concerns, I mean that a correction potentially brewing. Now, am I saying that 2 or 3 days ago was the ultimate top and that's it, and the run from 2009 is over? No, I'm not saying that. In fact, I don't see that right now. Now we could argue that there's a whole host of reasons why that should be happening, but I don't see it from how investors are behaving in the big picture. We don't see the classic signs of a market rolling over. But here's the situation we're in. I can be free by telling you that because I have systems in place that will allow me to get more conservative over time if that's what happens. And the prices dictate that. They dictate that. All of these indicators we watch, all of the news events and all these different things that we look at the end of the day, it's really about the prices. And the market will tell you when it's time to get extremely defensive. And I think if you're very, very nimble, could you have sold yesterday and maybe even shorted? Sure, but it's very difficult unless you're into day trading and all that to do that. And most of the people listening to this and watching this aren't generally that type of investor. Most of you have some investments, you're wanting to make some money maybe for the medium term, but I don't think many of you are day traders listening and watching this. So what we're trying to do is to determine, when should we be adding to positions? When should we be taking profits on things maybe we've had for a while? That's what I'm trying to do here. And so some of the things I will tell you are short-term trades, but they're not meant to be, 1 or 2 day trades. That's not what we're doing here. What we're doing is trying to allocate our capital. A lot of you are a little more advanced in age and you're looking to retire and you're looking to know when to protect yourself from a big downdraft. And again, as I've mentioned before, corrections can start at any time for any reason. And what we have to do is try to determine what's a correction and what's the real thing. And what we're seeing right now is, and I listed some of these items yesterday that I was concerned about. Things like, if you look at areas such as, let's take a look at utilities, which I've been long for a while. Utilities still, they were down 0.25% today, still leading the way. If you look at healthcare, I've been long healthcare for a while. Again, still leading the way. They were down about 0.6% today, just giving back what they made yesterday. If you look at these things, you may say, well, that looks great to me. It is, but a lot of people get concerned about when defensive areas lead a rally. If you look at something like consumer staples, which I have not been in, but if you look at consumer staples, again, they've been leading the way up in recent weeks. So while they just had a down day today for the first time, look at transports. Transports, have had 3 down days in a row, and some of this started with FedEx reporting a while back. You've also been seeing, as I mentioned just a few minutes ago, small cap and mid cap stocks really not participating and leading the market down. So they've been underperforming where they'd been outperforming for a while. We've also had less participation on the updates. You're not having as many stocks participating. You're seeing some negative economic reports. We saw a bad ADP number today, which is a jobs number. We also have bond investors. If you look at things like junk bonds, it's not that they were just plummeting the last few days, but they are underperforming treasuries. And so what you're seeing is people in the bond market shifting to safer types of bonds. And then on top of that, you've got things like, the Dow and CNBC talking about the new Dow high, and it's now at a new record high. So, you have these people that are, I think, getting a little complacent in the short run. And I don't think we're anywhere near where we were with the, irrational exuberance back in the 90s where people feel so confident that they're mortgaging their house to go buy stocks. We're not anywhere near there. However, is there some complacency in the last few months? Sure, definitely. That's just how the market has been grinding higher, and as the Dow Jones continues to move up, people have become complacent. And so for all those reasons, I thought that we could enter some type of correction. It's not something that I'm shorting, but I still have powder dry, and with the money that I don't have, I'm in some of these areas like utilities, healthcare. We talked about exiting financials a while back. Those have been getting hit the last few days here. They were down quite a bit, 1.7% today. Again, today was really the first day that we've seen some real intense action. It did intensify when we saw the situation with North Korea kind of escalate. Anytime you hear about somebody lobbing nuclear missiles and that they're authorizing an attack against the U.S. or whatever the news was, that's scary. However, if you go back and look, when markets are at highs like this, it's very rare for us, the stock market, all of a sudden just fall apart and go down 35% on news like this. That's not typically how bear markets start. So I don't think we're going to enter a bear market. But again, could we see a 5-10% correction? Easily. That's easily, and that's almost vibration. It's scary. I mean, think about it. The media is going bonkers over one day when the market's down 1%. Imagine what happens if we really do fall 10% or even 15%. So again, have your systems in place now so that you're not having to be down 15%, wondering what happened and what you should do about it. That's why it's so important to plan ahead. So we did have the ADP number, and the data showed that 158,000 jobs were created for the month, and the expectations were like 197,000. So well below expectations. There's a ISM non-manufacturing. It's another economic piece of data that came out a little less than expected. And, so you have to wonder, why isn't the market rallying? Doesn't the market want the Fed to stay involved here? The Fed is what's caused a lot of this rally. Remember, there's a lot of people out there who don't believe any of this rally is real. They think it's all because of the Fed. Well, if that's the case, the market should be rallying right now, not falling. So I think it's a combination. If they took the punch bowl away, the Federal Reserve, and said we're not going to buy as many bonds, there's no question the stock market would fall. But, if we get really strong data that's too strong and the Fed has to back down, the market's going to fall. So right now, we've been in this Goldilocks where the market's the data's been okay and the Fed's still been there. It's been the Goldilocks scenario. And so now we're seeing some of the economic data come in a little weaker than expected, and the market's starting to respond by heading down. So, just to summarize, the stock market did kind of break out here, and we've talked about these fake out breakouts, and I said that we would be at some inflection point. Remember on a few podcasts ago, talk about this inflection point we would be at where either we'd break out or we would roll over for a correction. And for right now, it looks like we started a breakout, sucked some people in, and now it may be rolling over and pulling back. So the first area obviously we want to look at is this old breakout area of about, let's call it 1532. That's only about 20 points. That's another bad day. And then we'll be starting to talk about the 50-day moving average, which the market really hasn't gone below since this whole year. And so that would be the next kind of line where you would watch that would bring in potentially more sellers. So we're watching that. So for right now, again, if you have these high beta positions, for example, double ETFs or transports or anything that's very, very cyclical. Those are the things that are really getting hit hard right now as people are getting more and more worried. So that's why you saw things like, again, bank sell-off, transport sell-off, even discretionary sold off. So people are shifting down the risk scale right now. Yes, they're exiting the market, but they're shifting down the risk scale. In fact, today wasn't even what they call a 90% down day. So this isn't one of those days where everybody threw in the towel on everything. There were some stocks up, but it's one of the worst days we've seen in about a month. The volume was a little higher today compared to yesterday, and it's above what we've been seeing. So volume did pick up a little bit. So if we see some type of little snapback, that doesn't necessarily mean that this correction is over. That means it may just be getting started. So you may have a chance, if you didn't sell some things, to lighten up. And I did get stopped out of a position today. But for the most part, I'm not making huge wholesale changes right now. What I'm looking for is when we do get a sell-off, what's the intensity of that? Is the volume start to dry up as we go down and people start to buy those dips? If they do, I want to be a dip buyer as well. All right, let's talk about Apple. Apple continues to be the inverse. I guess it's the hedge of the market. Who would have thought that when the market was going up, Apple would be going down, and now on these down days, Apple is going up. Apple was up the last couple days. Actually, yesterday got a downgrade, and the stock was up, and today it was up, and then it basically just finished up about $2, about 0.5%, but still bucked the trend. I've drawn these little green arrows because we could be entering this inverse head and shoulders, and this is the type of pattern that you would want to see. So if it does complete this, this thing's going like that. Now, does it go like this? Well, it wouldn't go backwards in time, I guess. But if is it going to go like this? I don't expect that. But could it be bottoming? Potentially. A lot of people believe that Apple's earnings have peaked and they may just flatline to where they're earning a bunch of money, but it's not growing anymore. Can you imagine that? This is a company that was growing at 100% practically a year on their earnings, and now they made flatline. They said that they were going to introduce an iPhone, or the rumors are, but it may look real similar to the iPhone 5 currently out there. What people are wanting, it seems like, is they're wanting a big phone to compete with Android, a bigger phone. One of these ones that look hilarious, like they're almost carrying an iPad mini around on their face. It's like we're going full circle with these phones. They started out these big bricks. I used to have one, and then they got really tiny. We had the little clamshells. They turned into little earpieces, and now we're going back and getting bigger because why? Well, they can do more stuff, and so we want more real estate. We want more screen size. So they're going back the other direction now, and it seems like Apple's going to have to do that, but that I don't think they're ready to do that. What they are apparently ready for is this Apple TV product, which I do think is going to be a game changer. I really do, and I think that they've proven that they've done it in music. They've introduced the tablet, basically. They weren't the first, but they perfected it. And I think that they will do the same thing with TV. It will introduce video chatting, which will be unbelievable. I think they will introduce a voice command to find any show you want. So I think it could be a game changer. I really do. And I think it's just a matter of, can they do it faster than everybody, and can it be a product that people have to have? And if it's obviously going to be a more expensive product than an iPhone or an iPad mini or something like that. It's going to be an expensive piece of technology. But I think that is something that obviously Apple investors are watching, and obviously still every day, what are they going to do with their cash? They've talked about potentially implementing some type of, a 50% cash return policy where they, if they have all this extra cash, it can't go below a certain threshold, or they will give it back to shareholders in some form or fashion or do something with it. And we'll see what they do with it. But the bottom line is, there's still a lot of negativity surrounding Apple. I'm not trading Apple. I'm still holding it. And for the most part, in the last few months, it's been dead money as it's been, kind of chopping around this 450 area. And it could go a little lower, but I don't have a big piece of it either. So I'm fully ready to buy more if and when that time comes. But the expectations are dropping so low that if they do start to surprise, the stock will take off. But just watch this pattern, this inverse head and shoulders, because I think that's something to watch. We had talked about Facebook, kind of the opposite, head and shoulders, and of course it had been falling and fell through and fell all the way down to $25 once we pointed that out, which was at $29. So it fell about 15% after we talked about that. So Apple could be doing the inverse right now. All right, how many of you heard about this Bitcoin? Some of you, I'm sure, have read about it, and others of you are saying, what are you talking about? Bitcoin. Bitcoin is a new virtual currency, and with everything going on in Cyprus and with banks, as governments confiscating money and people not trusting banks and the printing of more dollars, there's a digital currency out there. It's encrypted. It's anonymous, but it's a currency that is being used to purchase other goods. And, the concept makes a lot of sense. And this is something that's been around for a while, but there's been a few companies apparently that have tried to launch that have gone belly up. But basically, and this is the price, I'm showing you the price just over the last 24 hours. Bitcoin's, the value of it has gone from 118 to as high as almost 150. So can you imagine the value of the dollar moving by 50% in a day? That's why I don't think this is ever going to be anything. I think this is something that people are speculating on. I think the concept makes sense, though, that having some type of alternate way for you and I to transact a business outside of dollars. That seems to make sense, but just like a lot of inventions, they start out, but usually the people that start it or the idea, the one that started it isn't the one that makes it all the way. But people take the good parts about it, they get rid of the bad parts, and something else, it may morph into something down the road. For a while, obviously the dollar's still the place to be on a relative basis compared to other currencies around the world. Even though ours is being depreciated and devalued, it's doing it at a slower pace than the rest of the world. That's the way the rest of the world sees it. Hence, money has gone under the dollar recently. But this Bitcoin idea is interesting. And again, for those that don't know, this was invented by a hacker, apparently, and it's about 4 years old, but it's a digital currency, and nobody knows who invented this. The guy's still anonymous, or the gal. And but I think what's happening right now is you're seeing people again who are trying to make I was going to say a quick buck, make a quick Bitcoin on this because they see something going up in value and they're going, hey, I can buy something and kind of day trade this, kind of this fictitious currency. But you're going to hear a lot about Bitcoin because of this wild ride that it's on right now. And but look, I think it's a good idea. I just think we're long, for those of you who want to see something other than a dollar, we're a long way away from that, I believe. But is it the start of something? It could be. It could be the start of something. But I wanted to give you an update on that. If you keep hearing about Bitcoin but you don't really know what it is, that's what it is. It's this digital currency. It's encrypted. It's anonymous. And it's used to basically transact business, and some people are accepting it. But when you have a currency that goes from 118 to almost 150 overnight, and then back down to 126, and then back up to 139, that becomes too unstable for people to take it seriously. So, but keep an eye on it. That's something that you'll hear about probably more over the next few days. All right, let's talk about Facebook real quick. Again, coming back to it, the reason I bring it up is because we talked about the inverse head and shoulders, or the head and shoulders earlier. The reason I'm bringing it up now is because apparently the SEC is going to allow companies to post their earnings using social media. And so what's going to happen now is via Twitter, Facebook, LinkedIn, companies will post their earnings. As long as they tell investors in advance that they're going to do this, they're allowed to do this. And remember the CEO of Netflix got in some trouble for saying some things and using social media as kind of to communicate something that people thought he shouldn't have. Well, now apparently he was kind of the leader because the SEC is going to allow this. So, could Facebook benefit by now companies saying, hey, we have to, everybody that follows this company's earnings has to have some type of social media to follow it. So we need Twitter, we need Facebook. So you could see Facebook actually benefit from this little announcement. No, that's no reason to go out and buy the stock. I still really have trouble with the fundamental story behind Facebook. But again, kind of like Amazon, I have trouble seeing what's going on with Amazon and seeing the lofty valuations it has. I've talked about the quote-unquote it factor that Amazon has. I don't know if Facebook does have it, but this is one little wrinkle that could potentially help it, which is, more information going through these social media channels. And Facebook's obviously one of the leaders in the social media world. So keep an eye on that, because that is coming, where your Twitter feed will start to have earnings reports released. And so you're not relying on secondary information. It's coming straight from the companies. All right, just to wrap up, don't let one day freak you out, change your strategy, but also don't get too complacent. If you've been riding this market with very aggressive holdings, this is the time to scale back a little bit. This was the first day. May see a little pop tomorrow, and then perhaps, it'd give you a little better opportunity to sell. But we may gyrate here for a while. I mean, look, if you've got economy slowing down more than people thought all of a sudden, and you have North Korea with some serious talks of lobbing a nuclear attack, those are things that shouldn't be taken lightly. But on the other hand, again, bear markets typically don't start with that type of scenario. Now, a couple of you are looking for a scenario like this, and this is very technical, but this could be your shoulder, and we've talked a lot about Head & Shoulders. I should have had a Head & Shoulders little emblem on there, doing a commercial for them. We're not talking about the dandruff shampoo. We're talking about the shoulder, the head. Could this market come back down to this area, which is around the 50-day moving average, bounce, come up a little bit, and then roll back over and head down to a even lower low? If that's the case, maybe by that time the 200-day moving average. So again, I think that would be a place that would be easier to buy. It's been very difficult to buy things at these levels unless you're on some kind of, again, system or methodical trading system where you're doing either shorter-term trades or you're rotating in kind of the hottest places. But outside of that, it's been very difficult to buy. But that's a scenario some of you are looking at, is this Head & Shoulders type of pattern that could be developing, where we already had the left shoulder. Maybe we're at the head right now. We go down, we come back up to this right shoulder, and then we eventually either fall or we at least fall to a point where it's maybe the mid-1400s. So we're getting something that's a little more of a, let's call it a 7.5% pullback. And that's more of a real correction than something that we've seen here where we've had these, 3 or 4 day little pullbacks. Those aren't really corrections. Those are just, vibration. Something down to this level would be a real correction. That would obviously cause a lot of fear. A lot of people would be saying, aha, see, the market is going to go down. And we'll have to wait and see. Again, it's all about measuring how hard this is falling, how much volume is associated with it, what things are falling with it. And then we analyze it and say, yeah, this is something for real, or this is actually a buying opportunity. Okay, and we don't know that just yet, but this is a time to be a little cautious. If you have some profits and some things that would get hit in a down market, go ahead and take those profits. But other than that, I wouldn't sit there and, again, run for the hills, so to speak, just yet, because we've seen a lot of these fake moves where the market really does look like it's going to roll over, and there's really good headlines out there. Yesterday, what was it? It was the unemployment rates at 12% in Europe. Not good at all, right? But again, there were some negative headlines here. There's negative headlines here, and now we're having negative headlines. And the market has shrugged it off each time. Can it shrug it off now? We'll see. I'd say probably the most interesting thing going on right now is the fact that gold continues to fall. Gold is now erasing all those gains it had last summer and is back to the summer lows. And this may be a spot it may bottom, but you would think with some of this fear going on in the North Korea situation that gold would really be taken off, and it's not, because maybe people are sensing more deflation than inflation. And so watch gold. There's a lot of little lines in here, but we're reaching kind of this place it's been, at least on the GLD, a few different times over the past couple of years. I would say it had a little trouble before it broke out in the summer of 11. We obviously came down and tested that in early 2012. and then we tested it in the summer of 2012. So it's at a pretty key area of support right here. If it breaks through this at the 150 level, roughly the 150 level, look for it to fall down to the 140 level. And this is a weekly picture we're looking at. So it's kind of at an interesting point right now where, again, it should start to bottom if it's going to make a run. But again, I'm kind of staying away from a trading perspective. I've got a tiny little piece of it that's kind of a core position, but it's not enough to really keep me awake at night when gold moves down like it is right now. All right, guys, have a great day. Hey, thanks for the questions. We did that Q&A session last time and got some really good feedback from that. So, again, if you have any questions, and I'll either address them generally. Had some questions today. I just addressed generally. If it's something more educational, we'll go ahead and do a full Q&A type of session on that so we can have some educational pieces in here as well. But thanks for joining me. Appreciate it. Don't forget Google+. We're on Facebook. We're on twitter.com/Karl Eggers, eggerscapital.com. We're on LinkedIn. We're on iTunes, so we're all over the place to get the podcast. And, of course, you can always go through traderseyes.com or karleggers.com, subscribe on there, and you get these sent right to your email box. All right, have a wonderful evening. Take care.